Hi guys, it's Nitish, an anesthesiologist with a keen interest in spreading financial education and literacy. Since COVID, my YouTube stream has been bombarded with so many get-rich-quick schemes, videos about shitty, risky investment ideas getting million views, people claiming to be ex-employees of big investment firms, giving shady investment ideas, claiming that's how they became millionaires. Every other YouTuber trying to sell you some of the other financial online course. Ugh. I am so glad I didn't listen to a single one of them, but I do have a few unfortunate naive friends who did and ended up not doing so good. Hopefully with this video, some of you will understand that there are more stable, relatively guaranteed, and fairly risk-free ways of becoming rich. Really rich, with minimal regular investments. For example, let's say $18 a day. What's up guys? In this video we'll be discussing one of the smartest decisions you could be taking, and in the process possibly making hundreds of thousands of dollars by the time you retire, all while not giving up your avocado toast and Starbucks coffees. See what I did there? Yes, that was a Graham Stephan reference, and yes, I don't agree with some of the things he says. Again, topic for another video. Now, before you guys log off the video saying 60 is too late to retire, I say I agree 100%. My personal goal is to semi-retire by 40. Hey, that's just me, because I probably spent 15 years training to become a physician. Your goal could be 35, but still, that does not take away from the fact that everybody, I mean everybody, needs to have a Roth account. That guaranteed vehicle, increasing the investment cash over decades with compound interest, tax-free, that you could take out at 10.5 and buy that Ferrari or travel around the world or whatever you want to do. Or you could do what I'm going to be doing, is continue to live smartly without having to worry about cash flow by just putting all that money in a high yield savings account and living off the interest. So as you might already know, I am a physician and anesthesiologist. I went on to discuss the Roth IRA with my colleagues. Now picture this. Almost 90% of them were not even aware of what a Roth is, and almost 90% of the rest were too unmotivated or ill-informed about it actually to invest in it. Physicians are supposed to be some of the smartest, some of the most well-read and well-informed bunch of people. I was shell-shocked. This just went on to tell me about the degree of lack of financial education that is sadly prevalent in the US. But the good thing is, you guys are here, and through this channel, my goal is to tackle financial illiteracy so that each and every one of you can improve their financial health. Anyway, coming back to the Roth IRA. I'm sure you guys must be aware who Peter Thiel is by now, co-founder of PayPal. So he started with a $2,000 Roth contribution in 1999, which was the annual limit at the time, and he used this contribution to buy 1.7 million shares of PayPal for 0.1 cents per share, bringing his total purchase to $1,700. Now that went up in price to around $5 billion. Whoa. Wait, that's not even the kicker. The interesting bit is, now because it was in a Roth IRA, he'll be able to tap into this $5 billion Roth IRA balance 100% tax-free after the age of 59.5. Now that's some real smart investing. Kudos to Peter. The other interesting thing is that they have made it relatively temptation-free. Why do I say that? They know that the average American, myself included, will be tempted on seeing the cash in the Roth account and will think of taking some out to buy the latest Xbox or PlayStation. If you guys couldn't guess, I am a gamer. But the government anticipated that and put in a clause that if we try to remove any money out of the Roth account, the distribution will be included in the taxable salary, plus an additional 10% tax under the age of 59.5. This would serve as a reminder to keep the money in the account for as long as possible to continue to multiply it as time goes. That being said, you can withdraw your contributions without any penalty of tax at any point of time, even before the age of 59.5. But remember, once that contribution is taken out, it cannot be put in that same year. You can't be like, oops, I changed my plan and put it back in. When putting it back in, the $6,500 or $7,500 annual contribution limit would still stand. So the money that you put into the account is already taxed or is post-tax. So basically, the money which you get in your paycheck after tax deductions, you can put in 2023 up to $6,500 per year in the Roth account, or $18 a day, or up to $7,500 if you are above 50 years of age. Now imagine ending up with more than $1 million by just investing $18 a day. That just blows my mind. Now this plan is even more beneficial for people who are in a lower tax bracket now and expect to be in a higher tax bracket by the time they retire or 59.5 years of age. That would mean lower taxes now and then no tax in the future, when a traditional IRA would have been taxed higher. As a physician, I am trained not to directly tell you what to do, but with good conscience, I am telling you what I would have done if I could go back in time and turn 18 again. As soon as I turned 18 and started making some money, I would have started investing into the Roth and try to maximize it year after year after year. And when I say invest, I mean mostly in low-cost index funds like SWPPX, which I personally invest in. Why? That's a topic for another video. But if you guys want to wait until the video to invest, that's fine, but at least start transferring money into the Roth account ASAP. Just once the money is in the account, you can buy stocks, ETF, mutual funds, whatever you want. But like I said before, the sooner you buy, the better, so that it can start multiplying with compound interest sooner. By delaying investing into Roth by even 1 year, you could be losing out on tens of thousands of dollars. So if you started 18 years of age, using the Roth calculator and contributing $6,500 annually, you could put in almost $1,436,000, but in the Roth account with 7% rate of return, that amount could grow up to $2,469,000, all tax-free. But if you started at 19 years of age, that total amount would come down to $2,300,000. And if you started at 20 years of age, that would go down even further to $2,143,000. Lastly, you can only make full contributions to the Roth account when you are making under $138,000 in that year when filing taxes as an individual, or a reduced amount when making between $138,000 and $153,000. Similarly, you can make full contributions if you're making under $218,000 when filing as a couple, and the reduced amount when making $218,000 to $228,000 and filing taxes as a couple. You cannot make any Roth contributions if making more than $153,000 in the year and filing taxes as an individual, or making more than $228,000 and filing taxes as a couple. Alright, so what are you waiting for? Go open the Roth now. And none of that, oh, I'll do it when I have time. You guys are on YouTube. You have the time. Please go and make the smartest decision, and your future self will thank you while vacationing around the world. Now, I personally would recommend Fidelity or Schwab for the Roth from personal experience, as Vanguard wanted me to come to their branch and open the account, as I was and still am on a work visa, while Fidelity and Schwab have always been more than friendly, straightforward, and comfortable to work with. Plus, compared to some of the newer companies which have come up, I feel that these have stood the test of time. Wishing the best for everybody. This is Investologist MD. Please don't forget to like the video and subscribe to the channel. Do share this video to friends and family who you feel would find value in this video.